So the Fed mentioned that interest rates might see an increase a bit earlier than expected. And that kind of spooked out investors. Right now we can see the Dow closed about 0.7% down, the Nasdaq was down about 0.2%, and the S&P 500 was down about 0.5%. So I want to take a look at what exactly happened, but more important, I want to see if there's any changes I should make to my current investment style. So let's get started. Alright, so first the news. The Federal Reserve on Wednesday considerably raised its expectation for inflation this year and brought forward the time frame on when it will raise its next interest rates. And originally it was expected to be sometime in 2024, but officials now indicate that a rate hike could come as soon as 2023. And remember, at the moment this is not set to stone. These are just expectations. Right now, the way the quarters and inflation is looking right now is saying that, hey, we might have to increase interest rates a little bit sooner. But depending on how the upcoming quarters can do, all that can change. It can even be earlier than that, or it can be later than that. Investors are also a bit spooked out because the so-called dot plot kind of shows expectations of about 2 hikes in 2023. Alright, so next let's take a quick look at what higher interest rates mean to companies and why the overall stock market tends to not like it. So higher interest rates tend to happen when inflation is going up. So a way that the Fed kind of combats inflation is by higher interest rates. Higher interest rates does mean a change in the overall financial economy. First, it means people and companies pay more money on variable loans. Let's say you have, for example, credit cards. Credit cards will have higher interest rates in the future as borrowing money becomes more expensive. So the consumer will have less money to spend. At the same time, companies with high amount of debt, they are going to be paying more in interest now because they have some form of loans on them. Another thing, both consumers and companies trying to take out a new loan in the future will also have higher interest rates. With this, it means that the overall amount of consumer spending will decrease. So now I did what any investor would do, right? I went to Google and put how to invest with interest rates increase. And so I wanted to see what are some of the tips the overall online market tells us to do. And I wanted to see if any of those changes impacted the way I invest. So the first one I click, how to invest for rising interest rates. The first thing they say is invest in brokerage firms. And this is pretty much like financial companies. You're going to see your banks going up. You're going to see brokerage firms going up. And why? Because most of their money they make are from interest rates revenue. So when you borrow money from a bank, if they have higher interest rates, obviously they're going to make more money. So normally the financial market tends to do real well during higher interest rates. I'm pretty sure some of us can think about some fintech stocks, some growth fintech stocks that can do well during higher interest rates. And I might do videos on those later on. The second thing they mention is invest in cash-rich companies. This is telling you, hey, find companies with very low debt and with high cash positions. Next, they say investing in tech and healthcare. And this is pretty interesting, right? Because I do believe right now, it seems like everybody believes that all growth stocks are tech stocks. So I do believe some tech stocks might be kind of getting pulled down a bit, even though they don't really deserve it. And here they mention in the past 13 periods of rising interest rates, over the past half century, the healthcare and technology sector experienced average gains of 13 to 20% during the first year following an interest rate increase. So again, technology, there's plenty of technology companies out there that are profitable, that have strong positive cash flow from operations, and that have a very, very strong balance sheet. So not all tech companies are bad. Growth companies in general might have a bit of a slowdown, but at the same time, not all growth companies are bad either. So make sure to subscribe to the channel where I will be talking about these types of stocks in the future. There are some things that they mentioned that I don't think are meant for investors. For example, buy with financing. They're saying right now with interest rates pretty low, it's smarter to buy using form of debt. The other thing is sell assets that you don't need. And the third thing they kind of mention is lock into long-term supply contracts. So I wanted to see how this would affect the overall business world. I think as right now where we have interest rates pretty low, what we're going to continue to see is companies kind of making smart acquisitions, with very cheap debt at the moment, and we're seeing that a lot, right? I feel like every week we're seeing some of these popular stocks buying a new company or proposing a future acquisition. The second thing is I do believe companies will sell out of some divisions that they believe are a bit of a slowdown or a drag right now, while equity value is pretty high. I also clicked on another link, and here they mentioned that investors should kind of expect volatility and manage their expectations. Investors should expect high volatility due to the uncertainty over the pace of rates hikes. So as rates continue to hike, I feel like every quarter we're going to be going like this. Oh, are rates going to go higher this quarter? Are they going to stay flat? Are they going to go lower? So this kind of uncertainty is going to create some form of volatility in the market. However, even with greater volatility, equity markets are not expected to decline significantly in response to rising rates. So at the moment, I'm definitely not planning on selling any stocks, right? That's definitely not a thing I'm going to do. Some investors might get a bit spooked out about investing in heavy growth stocks. So now let's take a quick look at what we learned first. So what to do? What am I going to do? First, when I find stocks, I'm going to find companies with strong balance sheets, with more cash and less debt. Fortunately for me, when I look for companies, that's something I'm already looking for. The second thing, looking for companies with strong cash flow from operations, companies that are making money from their everyday business, not companies that are borrowing money from their everyday business. And the reason I'm looking at cash flow instead of earnings is because even though a company can be profitable in earnings, they could still be burning money from their everyday operations. So I prefer to look at strong cash flow from operations. And again, that's something I tend to do already. Another thing is find companies that are able to increase prices on its products. Now, this is something I might have to think about when investing in companies, but usually I'm investing in innovative growth companies. I can't see them not being able to increase those prices. Finally, invest in companies like tech, industrials, financial, health industry, consumers. These are most of the markets I hit, especially in the tech world, especially in the consumer worlds. So for me, there's really no changes in my investment styles. Like I mentioned, even though many might consider me a growth style investments, most of the companies that I own already have some decent form of cash flow positive. They also have some form of strong balance sheet, and which means they have strong cash and low debt. So in the upcoming episodes, I will be talking about some companies that match this checklist. So I hope you guys enjoyed today's episode. Take care, have a good night, and see you next time.